On August 15, 1971, President Richard Nixon severed the final link between the United States dollar and gold. The decision was framed as temporary. It became permanent. What followed was not simply a change in monetary policy. It was the beginning of a structural transformation in how value itself would be defined, manipulated, and eventually weaponized. The collapse of Bretton Woods did not just alter exchange rates, it fundamentally rewired the relationship between currency, debt, and tangible assets. And within that rewiring lies a pattern that has repeated across empires, republics, and monetary systems for more than 2,000 years. The Roman Empire did not fall because of barbarians alone. It fell because the denarius, once a coin containing real silver, was systematically debased. By the 3rd century, what had been nearly pure silver became less than 5%. The empire did not announce the debasement as policy. It happened gradually, coin by coin, decade by decade, until the currency ceased to function as a store of value. Commerce collapsed. Soldiers demanded payment in goods rather than coins. The state lost its ability to project power because it had lost the ability to preserve trust in its medium of exchange. This was not a failure of leadership, it was a failure of incentive structure. When an empire can no longer fund itself through productivity, it funds itself through dilution. The pattern does not change. Only the technology does. In 1920s Germany, the Weimar Republic faced a similar choice. War reparations, political instability, and a refusal to raise taxes created a fiscal crisis. The solution was the printing press. The result was hyperinflation. By 1923, the German mark had lost all meaning. A loaf of bread cost billions. Savings evaporated. The middle class was destroyed. What followed was not just economic hardship, it was the collapse of social cohesion and the rise of authoritarianism. The Weimar Republic did not intend to destroy its currency, it intended to manage a temporary crisis, but once the mechanism of monetary expansion is activated under duress, it becomes extraordinarily difficult to stop. The political cost of austerity always exceeds the political cost of inflation until the system itself breaks. The United States in 1971 faced a different version of the same problem. The Vietnam War, the Great Society programs, and the accumulation of foreign dollar reserves created pressure on gold reserves at Fort Knox. Foreign governments, particularly France under Charles de Gaulle, began converting dollars into gold at the fixed rate of $35 per ounce. The outflow was unsustainable. Nixon closed the gold window. The dollar became a fiat currency backed only by the full faith and credit of the United States government. What that phrase actually means is backed by the ability to tax, the willingness to enforce legal tender laws, and the structural dependency of global trade on dollar-denominated transactions. For 50 years, that system has held. But the conditions that allowed it to hold are now eroding. Silver occupies a unique position within this system. It is not money in the legal sense. It has not been used as official currency in the United States since the Coinage Act of 1965 removed silver from dimes and quarters. But it retains the characteristics of money. It is divisible, durable, scarce, and universally recognized. More importantly, it is consumed. Unlike gold, which is largely hoarded and recycled, silver is destroyed in industrial applications. It is embedded in solar panels, electronics, medical devices, and military systems. Once used, it does not return to the market in the same form. This creates a structural imbalance. Demand is rising. Supply is not responding proportionally. And the price, as reflected in paper futures markets, does not yet reflect the physical reality. The divergence between paper and physical markets is not new. It has happened before in other commodities. In the 1970s, the Hunt brothers attempted to corner the physical silver market. They accumulated hundreds of millions of ounces. The price spiked to $50 per ounce. Then the exchange changed the rules. Margin requirements were raised. Trading was restricted to liquidation only. The price collapsed. The Hunts were ruined. The lesson was clear. Physical accumulation can be countered by manipulation of the paper structure. But that lesson assumes the paper structure remains stable, and there is growing evidence that it is not. In 2020, during the early months of the pandemic, physical gold and silver markets experienced a dislocation. Futures contracts traded at significant discounts to physical metal. Refineries shut down. Transportation was disrupted. Dealers could not source inventory. Premiums spiked. The situation resolved when central banks intervened and supply chains reopened. But the event revealed a vulnerability. The futures market assumes delivery is always possible. When delivery becomes uncertain, the system fractures, and the fractures are appearing again. Recent data shows physical demand for silver at record levels. Industrial consumption exceeded 680 million ounces in 2024. Solar installations alone consumed approximately 140 million ounces. Electronics, grid infrastructure, and defense applications absorbed the rest. This is not speculative demand. This is embedded demand. It cannot be postponed or substituted easily. Meanwhile, registered inventories in futures-approved warehouses have fallen to levels that represent only a small fraction of open interest. The ratio of paper claims to physical metal has widened, and the system, as designed, assumes that most contracts will never demand delivery. But if that assumption breaks, the entire pricing mechanism becomes unstable. Governments are beginning to recognize this. The announcement of a $12 billion strategic stockpile initiative in the United States signals a shift in thinking. Critical minerals are no longer viewed purely through the lens of market efficiency. They are viewed as national security assets. Silver, whether officially designated or not, fits within that category. It is essential to defense electronics, energy infrastructure, and telecommunications. A disruption in supply does not merely inconvenience manufacturers, it threatens operational continuity, and when governments begin stockpiling, they do not compete on price, they compete on certainty. This introduces a new class of buyer into the market, one that does not sell when volatility increases, one that accumulates regardless of short-term fluctuations. The historical precedent for government accumulation distorting markets is well established. In the 1930s, Executive Order 6102 required American citizens to surrender gold to the Federal Reserve at a fixed price of $20.67 per ounce. Once the gold was collected, the official price was raised to $35. The revaluation was not a market event, it was a policy decision, and it transferred wealth from private holders to the state. The mechanism was simple: declare a crisis, compel surrender, revalue. The same structure has been used in different forms across dozens of countries and regimes. It works because most people do not act until the window closes, and by then the terms have already been set. Today, the mechanism is more sophisticated. There is no executive order compelling surrender. Instead, there is financial pressure. Margin requirements increase, leverage is withdrawn, volatility spikes, weak hands are forced to liquidate. Physical buyers step in at lower prices. The metal moves from speculative accounts to long-term holders, and the cycle repeats. This is not conspiracy, this is market structure. Leverage amplifies moves in both directions. When leverage unwinds, price declines regardless of fundamentals. But fundamentals determine where the price stabilizes, and the fundamentals for silver are tightening. Supply is constrained not because mines are running out, but because silver is primarily a byproduct. Roughly 70% of silver production comes from mines that extract copper, lead, or zinc. Silver is recovered as a secondary output. This means that increasing silver supply requires increasing primary metal production. But primary metal production is driven by demand for those metals, not for silver. If copper demand is weak, silver supply does not increase even if silver prices rise. The feedback loop is broken, and this creates a structural ceiling on how quickly supply can respond to demand. Fabrication capacity is another constraint. Raw silver exists in various forms, but retail-ready products require minting, refining, and distribution. During periods of high demand, these systems become bottlenecked. Lead times extend from weeks to months. Premiums over spot price widen, and the spot price itself becomes less relevant to the physical buyer. This is why lines form outside bullion dealers while futures prices decline. The two markets are experiencing different realities. One is driven by leverage and sentiment. The other is driven by logistics and scarcity. Asia has become a critical theater in this dynamic. In China and India, silver trades at premiums to benchmark futures prices. This indicates that local demand exceeds local supply, and that buyers are willing to pay more than the global reference price to secure metal. These premiums are not symbolic, they represent real transactions. And they suggest that physical flow is moving eastward, away from traditional Western storage hubs. If that flow accelerates, it will drain registered inventories and force futures markets to reconcile with physical reality. The reconciliation will not be gradual, it will be abrupt. The Strategic Stockpile Initiative adds a geopolitical layer. If the United States begins accumulating critical minerals as a matter of policy, other nations will respond. China already controls significant portions of rare earth processing. Russia holds substantial precious metal reserves. Europe is dependent on imports for most industrial metals. A stockpiling race does not lower prices, it raises them. And it introduces a dynamic where price becomes secondary to availability. Nations do not compete for the lowest price when survival is at stake. They compete for guaranteed access. This shifts the market from a financial instrument to a strategic asset. And strategic assets are not sold during downturns. They are accumulated. The historical pattern is clear. Empires that allow their currency to become untethered from tangible value eventually face a reckoning. The reckoning does not arrive on schedule. It arrives when confidence erodes and alternatives emerge. For decades, the dollar has functioned as the global reserve currency because there was no viable alternative. But the conditions that created dollar dominance are weakening. Debt levels are unsustainable. Fiscal deficits are structural. And foreign holders of dollar-denominated assets are diversifying. Gold reserves held by central banks have increased for 14 consecutive years. Silver, though not held in official reserves, is quietly accumulating in private and institutional hands. The transition is slow, but it is measurable. The danger is not that the system collapses overnight. The danger is that it degrades gradually, then suddenly. Confidence is a threshold variable. It holds until it does not. And once it breaks, the mechanisms designed to restore it become ineffective. Central banks can print currency, they cannot print trust. Governments can mandate legal tender, they cannot mandate acceptance, and markets can suppress price through leverage, but they cannot suppress physical scarcity indefinitely. The gap between paper and physical will close. The only question is whether it closes through orderly adjustment or disorderly fracture. Silver is not a solution. It is a symptom. It reflects a broader unraveling of the post-1971 monetary order. The system was built on the assumption that fiat currency, managed by technocrats, could replace tangible standards without long-term consequence. For 50 years, that assumption held. But assumptions are not laws, they are bets. And this particular bet is now being tested under conditions its architects never anticipated. The outcome is not predetermined. Structural reform is possible. Fiscal discipline can be restored. Supply chains can be rebuilt. But reform requires political will, and political will requires crisis. The question is whether the crisis will arrive in time to prompt change, or whether it will arrive too late to prevent collapse. History suggests the latter is more common, but history also shows that nations, when forced, can adapt. The window remains open, for now.